This week was a good reminder that the economy can cool without cracking, and markets are learning to price that difference. First, on the growth side, manufacturing surprised to the upside. The ISM Manufacturing Index jumped back into expansionary territory, and new orders rebound sharply. That's a real sign demand hasn't disappeared, even if parts of the economy are still uneven. Second, the labor market continues to soften at the margin. ADP private payrolls rose just 22,000 in January, and the weakness wasn't subtle. It was broad-based outside of health and education. That fits the low fire, slow hire dynamic we've been talking about. Layoffs aren't surging, but hiring momentum is clearly slowing. Third, inflation is improving, but it's not gone. Services activity stayed solid, but price pressures are still creeping up, and that's why the Fed doesn't need to rush into cuts yet. And finally, markets themselves are shifting. We're seeing more dispersion. Leadership is getting tested, especially in areas where expectations got stretched. Even within tech, competition in AI is pushing spending higher and valuation multiples lower. That's a healthy reset. Growth is still there, it's just not free. So what matters most for investors? This is an environment where selectivity and diversification matter more than bold market calls. Staying focused on quality, durable cash flows and long-term discipline tends to win, especially when the headlines are moving faster than the fundamentals. Thanks for tuning in. We'll see you next week with more insights.